Exceptions from deemed supply. This section outlines specific exceptional cases where certain transactions, even though they may resemble a deemed supply, will not be treated as such for VAT purposes under UAE VAT law. These exceptions are important because they relieve taxable persons from unnecessary VAT obligations in cases where either no tax benefit was previously claimed, the tax impact is negligible, or the nature of the transaction justifies a special exemption. This ensures that businesses are not unfairly burdened with VAT compliance requirements in situations where there is little or no impact on the VAT system. 1. No input tax was recovered on the goods or services. Explanation. A transaction will not be considered a deemed supply if the taxable person did not recover any input tax at the time of acquiring the relevant goods or services. Key points. Deemed supply rules typically apply when businesses recover input tax on assets and later use them outside the business, for personal use or exempt activities. However, if no input tax recovery was claimed during the acquisition of those assets, the assets are effectively outside the VAT system, meaning no output VAT should apply when they are later used. This ensures fairness, preventing businesses from being taxed on assets that were never treated as taxable acquisitions in the first place. Objective. This removes unnecessary VAT obligations when there was no prior VAT benefit, maintaining logical tax treatment. 2. Supply classified as an exempt supply. Explanation. If the supply itself qualifies as an exempt supply under the VAT law, it will not be treated as a deemed supply even if the supply fits some of the conditions of a deemed supply. Key points. Exempt supplies are those specifically identified by the law as not subject to VAT. Since these transactions already sit outside the VAT framework in terms of taxable supply obligations, the deemed supply rule does not apply to them. Examples could include specific financial services, residential property leases, or local passenger transport services. Objective. This avoids applying double exceptions or unnecessary VAT obligations to transactions that are already exempt from VAT. 3. Input tax was already adjusted under the capital assets scheme. Explanation. If the relevant goods or services were part of the business's capital assets, and the input tax has already been adjusted under the capital assets scheme, such transactions are excluded from being considered deemed supplies. Key points. The capital assets scheme allows businesses to spread and adjust the input tax they recover over the useful life of expensive, long-term assets, such as machinery, vehicles, or buildings. Once the input tax is adjusted through this scheme, any further supply or use of these assets outside the business does not trigger deemed supply treatment. This ensures that the capital goods adjustment rules already handle VAT obligations, preventing overlap with deemed supply rules. Objective. This avoids double counting or duplicate VAT adjustments for capital assets, ensuring consistent tax treatment across long-term asset life cycles. 4. Provision of samples or low-value commercial gifts. Explanation. If a business provides samples or commercial gifts free of charge, these transactions will not be considered deemed supplies provided their value remains below a specified threshold, set by the executive regulation. Key points. Many businesses distribute free product samples or small gifts for promotional purposes. To reduce unnecessary administrative burdens, VAT law allows such transfers to escape deemed supply treatment if the total value given to a particular recipient does not exceed a specific amount within a 12-month period. This allows marketing, customer loyalty, and promotional strategies to operate without triggering excessive VAT liabilities. Objective. This facilitates normal business promotion activities, reducing administrative overhead for small, non-commercial samples and gifts. 5. Insignificant total output tax on deemed supplies. Explanation. A further exception applies where the total output tax due on all deemed supplies to a specific person over a 12-month period is less than a specified amount, defined in the executive regulation. Key points. Even if some transactions technically qualify as deemed supplies, they will not trigger VAT obligations if the total tax amount is below a minimal threshold. This reflects the de minimis principle, which avoids imposing disproportionate VAT obligations for transactions with negligible tax impact. The threshold ensures that very small or low-value transactions do not require complex VAT tracking and reporting. Objective. This reduces administrative burdens for businesses in relation to very small or low-value deemed supplies, ensuring VAT compliance is proportionate to the actual tax impact. For more details, contact us.